John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, my name is John Ulzheimer and I am a consumer credit expert. And today I am going to answer a question that I get periodically that I actually think is kind of fun. So this one's going to be a little bit of fun for us to spend some time together today. It's, hey John, what is the worst credit advice you have ever heard? In 28 years, I'm not sure that I can identify the winner, the absolute worst piece of credit advice that I can recall. So what I'm going to do is I'm going to give you some examples of some really horrible pieces of credit advice, and I'm going to let you decide which one you believe to be the worst. I think I'm going to talk about three really bad pieces of advice. The first piece of advice, and you may be able to identify where this comes from and who says this type of thing, which is to avoid credit cards. Don't ever use credit cards. It's like somehow credit cards are evil. One of the reasons why people tell you to not use credit cards is because obviously the interest rate on credit card debt is so expensive, right? So I mean, the average interest rate is somewhere around 17 or 18% for a general use credit card, and so they're demonized, and people tell you not to use them. And so the downside of not using credit cards is A, you don't get any of the credit building aspects of a credit card, which are great. Number two is you don't get the portable capacity of a credit card. I mean, a credit card, this little slice of plastic is $10,000 of buying power, depending on the type of card. That's pretty powerful. It's a whole lot better than carrying around cash, and it's a whole lot better than carrying around a checkbook, and it's infinitely better than carrying around a debit card. And here's why. Number three is you get pretty fantastic fraud protections on credit cards. So if someone were to steal your credit card or somehow get their hands on your credit card number and abuse it and use it, you have zero liability for any of the financial theft of that card. You have a cap of $50 liability because of the Fair Credit Billing Act, and then on top of that, the major credit card networks, Visa, MasterCard, Amex, and Discover, all have zero fraud liability policies. And so unless you never report the fraud, you're never going to have to pay for it. So don't believe the hype that people try to convince you that credit cards are evil. Credit cards are actually the only form of credit where interest is optional, meaning that you don't have to pay a dime of interest on a credit card if you charge and then pay it in full every single month. You can't say that about a mortgage. You can't say that about a student loan. Unless you have a 0% auto loan, then you can't say that about an auto loan. So other than credit cards and home equity lines of credit, there is no other form of credit where interest is optional. So don't avoid credit cards. That's a bad piece of advice. Here's another one that I think is just horrible. Close credit cards that you aren't using any longer. That's a terrible idea. And here's why it's a terrible idea. When you close a credit card, you eliminate the credit limit from consideration in the balance to credit limit ratio, which is an important metric in both FICO's and Vantage Score's credit scoring systems. And so you may be thinking to yourself, well, why do I care about that? Well, you should care about it because it is worth a lot of points with respect to your credit score. And if you close credit cards that you're not using, especially ones that have really high credit limits, then you're making it harder for you to keep that balance to limit ratio lower. You may hear people talk about how when they close their credit cards, their scores went down. And that's why. When you close a credit card, you lose the value of the unused credit limit, and therefore your score can go down. So that's the other really bad piece of advice. If you have a credit card that you don't want any longer, run it through the shredder and forget about it. Leave it open. If you're worried about fraud, don't, because you have no liability for fraud. Again, run the card through the shredder, and the likelihood of anybody being able to use that account is practically nothing. And even if they are able to use it, you have no liability, so who cares? If you have an annual fee on a card and you're like, man, I don't want to pay this $79 anymore per year, think about the benefit of that card being open, and then ask yourself, is that worth $79 a year? If that card, if you eventually do want to use it again someday, either because you may become unemployed and you may have to use credit cards for a while, you may want to make a major purchase and you really need the capacity of that card, and then add on top of that the credit credit score value of having that unused credit limit on your credit report. Is that worth $79 a year? That's for you to decide. I would argue that it probably is. And then number 3, this is my favorite, worst piece of advice, and this one's actually more specific to a scenario. I had a consumer who had a $40,000 truck loan. He thought that it was hurting his credit score to have $40,000 of installment debt, because a truck loan is installment, meaning it's a fixed payment for a fixed number of months, like a mortgage loan or a student loan. And so what he did was he, not at my advising of course, he went and cashed out a portion of his 401k and paid off his truck loan. And his credit scores didn't go up at all. And he was baffled as to how could this be true? Why didn't my score goes up? Didn't my scores go up when I paid off this massive amount of debt? And I'll explain why. Number 1 is the only reason your score would go up after you do something with your credit reports is because the way it was originally being displayed is causing your credit scores to be lower. So you're not going to get a score benefit unless what's on the credit report is causing your scores to be lower. Installment debt is practically benign in credit scores. You can have hundreds of thousands of dollars of installment debt in the form of a mortgage, auto loans, student loans, and still have killer credit scores. It's very different than credit card debt. Credit card debt's a different animal. If you have even a modest amount of credit card debt, it can be very problematic for your scores. Installment debt is different. So paying off a truck loan is fine. There's nothing wrong with doing that, of course, because you're not paying interest if it is an interest accruing loan. But the method that was used and the assumption that it would yield a higher score, 2 massive mistakes. Number 1, because the score didn't go up at all, but what you did do is you now took money out of your 401k, which is something that you should never ever do unless it's just an absolute emergency, because now you've created what's called a taxable event. Talk to your tax advisor about now what you're going to have to do if you pull money out of your 401k before you're old enough to be able to take the required annual distributions or withdrawals from a 401k. Add on top of that the fact that now that's $40,000 that is growing either because it was either in a mutual fund or in individual stocks in your brokerage or in your 401k brokerage account associated with your 401k. And then you have to look at what the time value of that money is over the next X number of years, which you're not going to be getting. And by the way, if you took that money out as a loan against your 401k, then you're going to have to pay that back. So you really didn't do yourself any favors, and that probably was the worst advice that I've ever heard, is that someone was given this advice to go ahead and pull money out of a 401k to pay off a truck loan because they thought that it was hurting their credit scores. So if you have any other thoughts about the worst advice that you've ever heard, I'd love to hear about it, because I could do a supplemental video to talk about why it's bad advice or flip side, why it's good advice. So I appreciate you taking time to watch this today. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.